Hello and welcome to another of the Thompson Wright budget videos. This one covering a topic that was quite changed in the budget, which is inheritance tax.
Yes, inheritance tax. So I think, like we've done on a few things, some things didn't change, did they?
No.
So perhaps, Sarah, you could just remind us the rates of inheritance tax bands, what happened there?
So we've still got the nil rate band of 325,000. That's, I think, now going to carry on till April 2030. So
Yeah, there was hope, wasn't there, that they might increase it or start to kind of align it with inflation, but again, they've frozen it.
It's been the rate for a very long time and probably not as reflective as it once was of what is a reasonable estate. We still have our residence nil rate band, obviously, of 175,000. As long as your estate's below 2 million, and those rates, the 325 and the 175, continue to be transferable. So we've still got the situation where on first death, if somebody leaves everything to their spouse, obviously that's all, everything's free of inheritance tax. That spouse then inherits those bands. So that's all very much stayed the same.
It is, apart from one of the big changes of what will now fall into your estate, which we'll come on to a bit, affects that thing about
your £2
million estate value. So things like the nil rate ban could be affected by those. We'll come on to that separately. So the rates are still obviously 40%.
Is the death rate 20% lifetime rate? So a lot of people think of inheritance tax as a death tax, and it is primarily a death tax. However, there are certain instances, for example, if you move assets into a trust worth more than 325,000, that would actually trigger lifetime inheritance tax, and that's
immediate 20% charge.
And that's still the same. The reduction if you're leaving a certain percent of your estate to charity has all stayed the same. So pretty much the core of that part has stayed the same.
What about gifts out of income?
So gifts out of income is a really interesting point because there were a lot of rumours that was going to change this time. So that is where, if somebody doesn't spend all their income, which as people get older, you tend to find they don't necessarily spend all their income. We spend our younger years frantically working, paying off our mortgages and things like that. And then there will come a time in your life where suddenly you don't have children, you don't have mortgages, and actually sometimes people's income can be quite
surplus.
And one way to make sure that you don't increase your inheritance tax position is to gift that income, what we call regular gifts out of income, which is gifting to children or even grandchildren, income that you can demonstrate to be surplus. And there's a form that goes on the inheritance tax return.
You've essentially got to look at what you've got coming in, what your expenses are, everything, taxes, house payments, mortgages, if you've
holidays,
shopping, all of that kind of thing. And if you can easily establish, well, look, we've got a surplus every year, if you're gifting that away, it's not a chargeable.
No, and people we've got, for example, grandparents sometimes put that into pensions for grandchildren, because anyone can have a pension. So if you think about somebody who's got a young grandchild starting a pension, that could be quite powerful. And you haven't got to worry about that younger person wasting that money, because if it's going to a pension, they're not going to be able to access it till they're in their 50s. So lots of time for it to grow as well. So that we did think she was going to change, and she hasn't. The other thing I think we'd heard rumours might change is the capital gains tax uplift, which happens when somebody passes away. So if I try to explain this, so if you inherit something from a relative and they bought it for a very small amount, and by the time you inherited it, it's worth more, what happens currently is you can sell that and not have any capital gains tax.
Yeah, essentially,
you're treated as buying it for today's value.
It's rebased, effectively. Your asset that you once bought for 10 grand back in the day now could be worth 100,000. If it's passed to somebody on death, then its value, probate value, 100 grand. They get it at that 100,000, not the original 10,000. Even though now there was talk about, in order to preserve that, they'd start charging capital gains tax when people pass away. But thankfully, they haven't done that. That would have been a nightmare.
So both of those two quite powerful things have stayed, and both tools that we use in planning. So nice to know that they're still there.
Yeah. So there were obviously then, I'm sure you'll have seen in the press and by now, particularly Mr. Clarkson at his farm is upset by this one. changes to agricultural property relief and business property relief. So just talk us through perhaps what the rules were, what the rules are.
I was going to say, shall we start with
the impact?
What the rules were? So it's always been quite a powerful relief, and I think certainly from the point of agricultural property relief, a sort of necessary relief that if you inherited the family farm, the agricultural value of that family farm from whoever you inherited to whatever amount was exempt from inheritance tax. So people could leave big farms, and because people don't tend to farm for the profits, they tend to farm for the love of farming. Yeah. It allowed farms to carry on down the generations, and generally our advice was always, or the joke was always, that farmers died with the boots on, because a farmer was always a farmer, to make sure they got their claim for.
And the other reason is that particularly in more recent times, we understand, don't we, farmers asset rich, cash poor.
Yeah.
So yeah, that changed. So that was what it was.
And now
100% relief. Now
only the first £1 million gets, which especially when you're thinking about farms, and if you've got a farm with a decent acreage and some
buildings and some equipment yeah.
and a decent herd, in all honesty, that £1 million could be breached quite quickly. Easily. Now, so this change comes in from
2026, 5th of April 26.
Now, I think we need to say at this stage that we haven't actually seen many rules. She gave some headlines.
Yeah.
I think there's a lot of consultation still to be done on this. For example, we don't know if that £1 million is going to be transferable between spouses in the way that the other reliefs are. We don't know a lot of things about it yet. Yeah. And so there's more guidance expected. I think we need to touch on then business property relief, sort of the sister relief to agricultural property relief.
Affects shareholders and other business owners.
Yeah. So again, that was always unlimited. So
if you got a trading company or a trading business, whatever value there was, it was covered by this relief, business property relief.
And again, we've probably in the past, advised clients to pass on other assets other than the businesses to their children. Keep your business, keep your trade, keep getting your dividends, because you were going to be able to pass it inheritance tax free and then benefit from your CGT uplift. That again has gone down to £1 million. And then the one that's perhaps a little bit more obscure, but certainly we know a lot of people use it, was obviously the change to AIM listed shares.
So we've got a number of clients where they've sold a business, realised that value, and then I've got cash, which is an assessable item for IHT, and then have made BPR friendly investments, usually through the AIM stock market, so as to carry on that BPR. They've now restricted that to basically you get 50% relief.
You get 50% relief, and there's no £1 million with that. No £1 million. So for APR and BPR, it's £1 million still free, and then like you say, 20% inheritance tax rather than 40%. But then for the AIM shares, it's straight into 20% inheritance tax with no £1 million. So some quite big changes. Yeah. Like I say, not yet. And again, a little bit scant still on the full details.
Yeah, I think the government have said that they'll publish a technical consultation in early 2025, which will let them form up and firm up the rules and all those other things that we're not quite sure about yet, so that it can be in place for the start of the 26-27 tax year. But one thing that obviously we do know that hasn't changed is the 7-year rule. So gifts that are made now start a 7-year clock. So people have been starting to think about what they can do. Can they start giving away some value to cap their estate, or certainly their business estate value at that £1 million? Farmers perhaps bringing in spouses, bringing in the next generation.
We'll see a lot of trust planning as well.
To start spreading out that £1 million. I mean, obviously, if you've got a sole trader farmer, he's got £1 million. If he brings his wife in, now he's got £2 million. And if he brings his adult son and daughter in, he could have £3 and £4 million. So it's things like that. So obviously, but doing that is a gift still. You've got a 7-year clock, apart from obviously the spousal transaction. So just things to be thinking about there, really.
So that was one really big change. Yeah. And then the other really big change, obviously, is the change to pensions.
Now, this has been... pensions were a concern going into the budget. Were they going to get rid of the tax-free lump sum? Were they going to start charging employers national insurance on employer pension contributions? and even discussions about what they have done, which is to effectively, pensions at the moment do not form part of your estate for inheritance tax. From the 5th of April 2027, any unused pension pot, quite exactly what that means yet hasn't been defined.
No, I think she said slightly different words on the day of the speech, but it's been clarified since.
Yeah,
it means I think
undrawn. So if you've got a pension pot in your name that is undrawn after the 5th of April 2027, it will form part of your estate for inheritance tax purposes. Now that quite damaging for a number of our clients that we've advised.
Yeah. So normally, I think
funds into pension
for a long time, advice has always been leave your pensions till the last part. Yeah. Spend all your other savings, leave your pensions alone. It's going to be a bit of a quandary now. Do I take some money out of my pension and potentially pay 40% income tax to save 40% inheritance tax? So I think there's going to be, I think the other thing with this is, and why we really need to wait for the guidance, is obviously it will be the pension companies themselves who will be responsible for paying that part. So, it won't be like other assets where you're perhaps going to find the money to pay your inheritance tax. The money's obviously going to come from the fund.
From the fund, yeah.
But again, sometimes perhaps people use pension funds to fund other IHT bills. So it's going to be.
But again, that one comes in from the 6th of April 2027. So again, very little in terms of technical understanding about what the draft legislation is going to look like. There isn't anything on HMRC's website yet. It's just we know that this is one of the things that they're bringing in. But again, that will be our job. Make sure we keep on top of these things, advise our clients like yourselves, so that if there are things that we can do in the meantime, and once we do start getting an idea of how this is all going to work, then we can obviously start advising accordingly. But I do think it makes all the more powerful that tax-free lump sum that still is available, isn't it? The 25% drawdown.
And I think you can't detract. I think pensions are still a very powerful tool. If you've got a building inside your pension, it's still getting the rent tax-free.
Yeah.
Growing potentially that 25% and things like that. So, and
pensions aren't subject on their assets within the pension fund. They're not subject to CGT. So again, you might have a property in there. It comes to the day where you want to draw it down. You want to start liquidating that pension to make access to it. You can still sell the property within there without any capital gains tax. So again, it is still useful. But obviously now there's this other change with regards to inheritance tax. So again, as and when we get more information, obviously
we'll obviously update the
update guidance accordingly. Yeah. So those are really the main changes with regards to inheritance tax.
Yeah, pretty significant.
Some pretty significant ones, yeah. That's going to affect people.
Vague, but
yeah. But as we say, if you've got any more questions, if you want any more advice on inheritance tax, estate planning in general, please contact us, specifically Sarah. She's our IHT expert. So by all means, send your questions and get in touch with us. We'll be happy to help. Thanks for your time.
Thank you for your time.